So the International Accounting and Auditing Standards Board has issued an exposure draft on fraud and proposed changes. And the Auditing Standards Board of Canada has issued a document. It's on the web. We're going to fact check that document. And if you want to see it, it's practitioners, how will the changes impact me? Now, before we start, there's some things we need to understand about fraud and fraudulent financial reporting. Now, the international body is at pains to point out that the definition of fraud does not include corruption, bribery, and money laundering, and they say they're doing something about that, but they have left the definition in the requirements section the same. Talked about corruption, bribery, and money laundering later on in the appendices, but those are not requirements. So we have to beware of several things. And the definition of fraud, the old and the new definition of fraud says it is intent to deceive. And probably the intent part is less important than the deception part. Fraud is about deception. Some people have said to me, well, everything you do is intentional. So if you define fraud as intentional, then everything is fraud, because you may not have intended to make a mistake, but you made it. It must have been intentional to do what you did. You didn't realize you made a mistake. So if the definition is only intent, you got a problem. And in both the old and new document, they tend to drop the deception part and say it's only about intent. So paragraph 4, they say the difference between fraud and error is intent, which is, of course, inconsistent with the definition in 12 and 18 and makes no sense. So be careful about this. Don't get confused, and remember, it's always intent to deceive. So paragraph 4 would be better to say that the difference between fraud and error is intent to deceive, or just the difference is deception. Fraud is deception. Error is there's no deception or intent to deceive. So don't get confused by that. You can run off on all kinds of time-wasting tangents if you just talk about intent. Now, the other thing to remember is fraud is most likely found as error. You're doing an audit, something looks unusual, you identify it, it's wrong, and you may go to management and say, hey, we found this error, and management may say, oh gosh, did we do that wrong? We should fix that. So you identify it as an error, fix it as an error, but never realize that the underlying cause was fraud and that management actually intended to deceive. But unless they confess and go, oh yeah, you got us, we were trying to commit fraud there. We were trying to commit fraudulent financial reporting. You got us, ha ha ha. That's unlikely to occur. Now, the other thing we've got to remember is we are looking for material fraudulent financial reporting. We don't care about fraud. We care about whether the fraud has materially misstated the financial statements. And there's lots of things that are defined as fraud that are going to occur. An employee is going to steal a pencil from the supply room. That's fraud. But it doesn't result in fraudulent financial reporting, and it's immaterial, and we don't care as auditors. And that's the same with error. We are not looking for immaterial or trivial errors. We are looking for material misstatement in the financial statements. And in 315 is whether caused by fraud or error. We really don't care. We're just looking for material misstatement. Now, both the exposure draft and the current standard mix this up, and they talk about finding fraud, and they drop the word material, and they drop the word fraudulent financial reporting. And if you spend your time looking for fraud, you're going to waste your time because you're not going to find anything that requires a journal entry. In an audit, if you think about it, everything you do, every procedure you perform should have the intention of finding a journal entry, intention of finding a material misstatement that you wish to suggest should be corrected. And if you're doing something that cannot find that, you're wasting your time. So be careful about that. We're looking for material misstatement, however caused. And also remember that we're unlikely to find fraud. The number of frauds that materially misstated the financial statements that an auditor finds in their career, one or maybe two. And again, you often first trip over it as an error. You find something that's wrong. You go, well, that doesn't look right. And if it is committed by management at the highest level, and they have successfully concealed it, they've used collusion, they've got third parties to help them conceal it, the odds of you finding it are very, very small. If it's something that's been done by a junior staff person and you point this out to senior management and they go, well, that's wrong, we should fix that. And even if you do fix it, you're unlikely to identify it as fraud. So be careful on wild goose chases for fraud. And the new document continues to mention it, though they continue to kind of conceal. They don't want to say out loud that we're not going to find it. But they do say, while the risk of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting one from error, and then they keep talking about how we should continue to look for it. And of course, there is a risk of not detecting a material misstatement from error, and we say that right now in the audit report. We say we may not find material misstatements. So they acknowledge that it's unlikely, the odds of finding fraud are unlikely, but they're not as clear about it as they used to be. So just have to remember that. We're going to try to find fraud, but the odds are very, very low. Now, A176, interesting paragraph. Now, this is not a requirement, but it's a suggestion. Therefore, it may be rare that the auditor of a complete set of general purpose financial statements of a listed entity would not determine at least one key audit matter related to fraud. Now, may means the same as may not, so it would be rare that they may not. I don't know what that means, but I think what that probably tells you, if you are the auditor of a listed entity, you'd better make sure that you identify at least one, and 2 or 3 or 4 would be better, and disclose those as key audit matters. You know, there may be fraud here, and there may be fraud there, and there may be fraud here, and there may be fraud there, and that gets the auditor off the hook. Now, standard setters talk about this as transparency. You're being transparent about what could happen. But if you have an audit report littered with lots of key audit matters, all of which effectively say, yeah, we've done an audit, but this could be wrong, and that could be wrong, and this could be wrong, and this could be fraud, and that could be wrong, and this could be fraud. Not sure how valuable that is to the user. In the old days, you used to say, in our opinion, the financial statements are fairly presented. And we kind of don't do that anymore. We have all kinds of disclaimers and qualifications, and we call them key audit matters. And I'm not sure that that makes it more useful, but never mind. Now, the other thing that isn't provided if we want to find fraud, things like examining witnesses under oath and the right to arrest and prosecute, which the police forces have, and even with that, they're not particularly good at finding and identifying fraud. And if we did have those powers, it would probably make audits impracticable because people would not talk to us. They'd say, go away. Unless you have a search warrant, I'm not talking to you. So We still just have the same old audit procedures we've always had that always, since the beginning of audits, have made it difficult to find error and even more difficult to find fraud. So rewriting a standard without providing procedures to increase the likelihood of finding fraud isn't going to make any difference. Now, the Auditing Standards Board of Canada has provided some advice on the changes, and they have a somewhat annoying tendency to say things are new when they're not. It's like advertisers, the new this, new and improved. And only an advertising person would argue that it was either new or improved. But what this does to practitioners, it makes practitioners think that changes are needed when they're not. And as I said at the beginning, they have provided a document where they describe the new features. How do the changes impact me? And they have many comments in there. I'm not going to go through them all, but I'm going to fact check some of those claims. I like fact checking. So here's the first claim. Professional skepticism. This is enhanced throughout the standard with a new requirement to remain alert throughout the audit for information that is indicative of fraud or suspected fraud. Now, the requirement to alert is in the definition of professional skepticism in the glossary. It's in SQM1, paragraph A31. It's in 213, 200A21, 315A14. And actually, the comments in 200A21 may be more comprehensive than are in the exposure draft. So it's not a change. How might this impact practice or forms? Well, it's difficult to document being alert. That's a state of mind. I guess the only way you can really do it now is document I remained alert, initials and date. If you do not now have that in your set of forms or as part of an audit conclusion or something, I remained alert, you should add that now. And if, depending on the wording, you might want to say I was alert to material misstatement due to either fraud or error. So it's no particular change, but you might wish to check that your forms adequately document that you were alert. The next claim, engagement resources. There is an emphasis on determining that the engagement team collectively has sufficient time and appropriate resources. Well, there's currently a similar, though perhaps less detailed, but probably meaning the same thing, requirement in 240.30a. It's now required by SQM 132, 220.25, 228, and 30b, which are probably more detailed, as well as requirements in 300 and 315. So it's not a change. So changes to practice and forms, really none. It's already required. And anyway, all you're going to do is document as an engagement partner, I determined that my staff had appropriate resources. And it would be incorrect to determine anything else. I planned the audit and did not provide my staff with appropriate resources. So I think it's always the case that you're of the opinion that you provided appropriate resources, so you should document that. Engagement team discussions. These discussions include specific fraud-related topics with additional considerations for the timing of discussions and the attendees. Now, it's essentially the same requirement as 240.16 and in 315, though arguably it does go into a little more detail. And the requirement to have engagement team discussions led by the engagement partner has been in standards for a while. So if it is a change, it's a trivial wording change. So on balance, it's not a change. Now, change to practice or forms. Perhaps if you have a documentation or suggestions about things that should be included in the engagement team discussion, and you wish to have a list of things, I verify that all of these things were thought about and or discussed as necessary. You might wish to expand that checklist, but seeing you're required to consider fraud now, adding a few other things to say you thought about isn't particularly going to change anything. This is a documentation requirement as opposed to a change in performance. Now, the other thing they've done is there used to be a requirement that this discussion took place setting aside assumptions of management honesty, and they've deleted that. And they haven't said it anywhere else. So effectively, this reintroduces the assumption of management good faith, which they were at some pains to delete the phrase assumption of management's good faith, while continuing to say in other places and more quietly that that's what we did. You could not do an audit if you assumed that management was always lying to you and every document they presented to you was fake. It would be impossible to do an audit. Another claim, understanding the components of the entity's system of internal controls. A combination of new and enhanced requirements focuses on understanding controls. Now, this is basically the same as current 27 with a few more words. 315 makes it clear throughout that it is addressing material misstatement both due to fraud and error. So it's not really a change, though there are more words. A tweak to checklist wording at most. Application material clarifies that due to the significance of fraud risk factors related to revenue recognition, both individually or in combination, it ordinarily makes it inappropriate to rebut the presumption of risk of material misstatement due to fraud in revenue recognition. Now that, I say suggest, it says that revenue is always materially misstated due to fraud in every audit. It's saying that at every client and in every audit, management has deliberately materially misstated revenue to produce fraudulent financial reporting. And that is, of course, preposterous. It's a silly suggestion. Now, you could very clearly be confused by that and think that you had to do it. Now, it's only in the application material. It's not a requirement, so you can cheerfully ignore it, I suppose. But it's not a change, because if you look at new 70D, which is the same as the old requirement, it says you can, if you have dismissed that presumption, you have to document why, which would be simply my analytical procedures didn't lead me to believe that there was material misstatement in revenue due to fraud. So it's not true. Changes to practice or forms, none. Just be careful that you don't start doing that in every audit and then adding 3 or 4 days worth of work to determine that there is no fraud in revenue recognition. For there to be fraud in revenue recognition, there has to be an overstated accounts receivable. Though I suppose if you have a very, very complex revenue recognition scheme, contracts, percentage of completion, could be wrong, whether it's fraudulent or not. Management may be pushing it a bit, but they're not intending to deceive. And I guess then that's time for a key audit matter where you provide a qualification effectively that, hey, we're using a complicated revenue recognition method, and it could be wrong, could change. Maybe we do that. In a small firm, in small, simple clients, no change. Now, the other thing they do throughout is they say, when applying 315, some section or other, do the following about fraud. Now, in the big picture, you should already be doing that because you have to consider fraud and error all the time. Now, I don't know that this is going to change performance, but it should probably change documentation. When I was applying that section, I thought about the following with respect to fraud. And my procedures did something about it. Now, it's not a change. We should be doing it now, though in terms of documentation, this is all required now I think maybe what this section is going to require is a 2 or 3 page standard piece of documentation, same in every audit effectively. Maybe slight changes if it's more complicated, saying I did all those things. All the things required by new 240, yeah, I did, or they were irrelevant, or I thought about them. So I think, again, this is just a documentation change, not a performance change, because you should be doing it now. And I guess if you're not, useful hint that there's something you should have been doing that you weren't. But again, audits are repetitive. So you did an audit last year and you're doing an audit this year. If there was something wrong in last year's financial statements and they've repeated it, they've recorded more phony sales and have more and larger phony accounts receivable, you're going to look at it and say, why are all these receivables 2 years old to customers whose names I don't recognize? Oh my goodness, they are messing around with accounts receivable. And if the client goes, oh gosh, did we do that? That's a mistake. Oh, we should fix that. You won't identify it as fraud. You may suspect it, but you're not going to identify it as fraud and you'll fix it. So not much of a change to practice. Journal entry testing. There is a new requirement to obtain audit evidence about the completeness of the population of all journal entries and other adjustments made. Now, presumably the population of entries made in the books are all in the books. And any journal entries that are not in the books are not in the books. Now, they give no hints as to what that means, even in the appendix, other than to say you might use a computer. But I think normally you're going to conclude, particularly in a smaller audit, this might be a problem in a bigger audit, but you're going to conclude in a smaller audit, all the recorded journal entries are recorded. And there are no unrecorded journal entries that should be recorded because there aren't any. So particularly in a smaller audit, I can't see this having much of an impact. Maybe you want to add some words to a form saying, I thought about whether there were any population issues with respect to journal entries. And maybe in a very, very large audit, that's a problem, but I'm having trouble seeing that, having trouble understanding what one might do. And there are no hints in the exposure draft. The auditor's report reflects the additional communication with those charged with governance about fraud. So, in addition to noting in the audit report that we may miss material misstatements, which is kind of an overall qualification, if later someone say, hey, you gave a clean audit opinion and we found a material misstatement, you will say, well, read the audit report. It says we might have done that, so we told you already. So this is now suggesting similar disclaimers that the statements may be misstated because of fraud. The only thing this does is relieves the auditor of liability, though I guess you have to be careful to toss in lots of observations about how the financial statements could be materially misstated because of fraud and why you might have missed it and what you did, but it still could be there. So certainly in large firms or in large audits, public companies, listed entities, they're going to be saying this all the time. This is something perhaps even you don't have to in a smaller audit where you might wish to introduce a key audit matter saying, oh yeah, it could be misstated by fraud. Scalability considerations, they say they have done a really good job of allowing this to be scaled. I guess that's true, but it's not particularly well done. The only thing they say is, in the case of a smaller or less complex entity, some or all of these considerations may be inapplicable or irrelevant, which is the same as old 828. So it's really not well done, and it hasn't described, for instance, this completeness of journal entries thing. How might that apply in a smaller audit? They don't do it. So it's badly done. And you will have to use that sort of general exhortation. Well, it was a small audit, so I didn't do that because I didn't think I needed to, please see that paragraph in the appendix. So I don't know that much is going to change. A final problem they have, and this is in the old document and the new one, and I love the word conflate. They continue to conflate fraud with fraudulent financial reporting. And if you want to get confused as you're reading through the document and finding a single paragraph, you go, hey, it says we got to find fraud, material or not, and find fraud that is not fraudulent financial reporting. Somebody steals a pencil, that's fraud, but it's not fraudulent financial reporting either because the office supplies are not misleading or not recorded as inventory, or if someone stole something, it's, as long as inventory is correct, it's fraud, I suppose, in the definition, but the financial statements aren't wrong. So, for instance, they have an example. Certain characteristics may lead you to be more susceptible. For instance, inventory items that are small in size, of high value, or in high demand. That basically says that the financial statements of any retail business are materially misstated by fraudulent financial reporting because customers or employees or management or somebody stole it all. Now that is theft. That is not fraudulent financial reporting. And that might be something you would consider in terms of deciding, do you want to count inventory at all, or at year end, or ahead of time? Now, if you're dealing with a retail business, presumably they're constantly monitoring their inventory and they're constantly monitoring what they call shrinkage, and they're well aware of that because they're not particularly focused on fraudulent financial reporting. They're focused on trying to stop people from stealing stuff. So it's theft. It's not fraudulent financial reporting. It's a lousy example to include about fraud, and it's something that will mislead an auditor potentially into spending a lot of time on that, when probably the right answer is we'll count inventory at year end, thank you very much. We will observe the inventory count. Don't care when the client counts it. We'll observe year end inventory count. Considerations specific to public sector entities, and I quote, but basically that says individuals in a significant role may put through fraudulent expense reports and claim travel that wasn't. Now, that's not particularly characteristic of public sector entities. That could be anywhere. And that's fraud, but it's not fraudulent financial reporting. If somebody puts through an expense report for travel that wasn't related to the business, fraud or not, the financial statements are fairly presented because that is an expense. You don't disclose fraudulent travel expense as well as non-fraudulent travel expense or accommodation or entertainment. It's all part of expenses, fraud or not. So that's fraud, theft, but it's not fraudulent financial reporting. And if you as a public sector auditor spend a lot of time on that, it's almost impossible to find until someone confesses. Or until management notices that, hey, how come travel is 10 times what it used to be? And these things, I mean, you see them reported in the press all the time, but typically they've been going on for years until somebody twigs to the fact that travel is way above budget. I was involved in one of these. We found a small amount, challenged the general manager, and my advice was tell him that he needs to confess and reimburse us. We thought he'd stolen, I don't know, I'll make it up, $10,000. He confessed to $30,000, wrote a check, and resigned. We never would have found it. Never, ever, ever. It just is not detectable. So it's fraud. It's not fraudulent financial reporting. Don't get confused. So on balance, most of the claims that there are big changes are not big changes. Any changes are mostly documentation. This annoys me because most of the standard changes are now dealt with by additional pages of documentation. There are no performance changes. And as I said at the beginning, fraudulent financial reporting is rare and more rarely found. So I will suggest that you should read the document and decide for yourself, and decide whether or not you wish to respond and tell them that you think there are things that should change. Now, the other thing I think this does is these changes cater to a widening of the expectation gap. I don't exactly know. Maybe the International Board is under pressure from people to say, hey, we think auditors should find more fraud, and they are not brave enough to say, well, we can't. But we are implying to the public that audits can find fraud when they cannot. They can't. It cannot be relied on. It'd be nice if it could, but it can't. But then what they do is allow multiple disclaimers in the report, and indeed encourage you to say, well, there could be fraud here, and there could be fraud there, and there could be fraud here, and there could be fraud there, but we didn't find it. Here's all the work we did. We increased our fee to do this. So we're giving the auditors a legal liability out on this disclaimer on fraud, and those with small audits may wish to follow suit as well as on listed companies. So thanks for listening.